Let's get going. Welcome, everybody. Thanks, everyone, for tuning in. Got a good one for you tonight. We're going to have a real good, we're going to have a focus tonight on risk management, right? Risk management is the foundation of every trader's success and failure, right? So that, you're looking for a root cause, why you're succeeding, why you're not, or maybe not why you're failing necessarily, but why you're not where you can be. You're not reaching your full potential. Well, look to risk management, right? This session will cover what I feel is essential to building that foundation. So for those of you who have not been a part of the summit, we had a class last Monday before Thanksgiving about, it was really goal setting and just motivational stuff. So you didn't miss anything too key. Tonight is really where we're going to start diving into stuff. And we talked about building this trading playbook, right? Coach Dipka, we got the playbook going, and I'll dive more into this in a couple slides, but it's so essential that you come to every trading day with a plan, right? And with a model, a trading model or a trading system, right? Because when you have skewed, when you do things emotionally and when you base decisions on emotions, what happens is you get really varied results, and it becomes very hard to pinpoint inefficiencies in your own trading model and, maybe shortcomings of, where you're failing, right? Because if you do, I'll give you a good example right now. If you take an EMA strategy one day, right, and you do that on Monday, and then you take a fib on Tuesday, and then on Wednesday you take a key level, you're getting like varied results. One day the fib's going to work, one day it's not, right? You need something a little bit more consistent. That also lines up with risk. So we're not going to dive into my strategies yet that I've been working on to, my real trading model, but we're going to start with the foundation, which is risk management. So let's dive into it. I'm going to start with an open-ended question for all of you. Hold on here. One second. All right, there we go. Screen was frozen there. Sorry about that. Again, we're going to use the Discord chat, and everyone should have access. It's the free room. It's called Member Chat in the Discord. So I'm going to ask you guys the open-ended, and I'm going to ask you to answer a couple questions just to get your minds thinking here. So what do you guys feel? And there's no wrong answer. What do you feel is the hardest part of trading? Okay. Throw it in the chat if you want. If not, all good. So I just want to get the minds going here. What is the hardest part of trading? What part of trading sucks the most? I'll give you some ideas here. What do you think? And there's no right answer here. I'll tell you mine in a sec, but you got TA, developing and winning strat, risk management, patience, account drawdowns, right? Overcoming account drawdown days. But that's one of the hardest things for sure. Okay, looks like emotions, risk management, emotions. Right, risk management obviously seems like the obvious one because it's the what the session is based off of tonight. But again, no right or wrong answers, just more of an open-ended thing here tonight. Finding a good entry point, that's a good one. Yeah, that's a tough one. That one we're going to cover in week 6. I mean, you guys know how precise I try to be. Some days it's easier than others. Drugs. I mean, hey, if you're on drugs trading, that's going to make it tough for sure. Not a bad answer. Cutting losers fast, stick to your rules. Yep. All right, so I'll share mine with you. I believe the 2 most difficult aspects of trading are, number 1, controlling emotions, and that discipline factor. Can you be disciplined in, the biggest thing for me that I've learned in my years of trading is when there's a leg in the market and you didn't have a level, you didn't have a setup, right? You don't have to trade every single leg of the market. You have to get used to that. And if you're on Twitter and you have notifications for every furu, you're going to see, holy shit, this guy hit a 40%er. This guy hit a 50%er on that leg down. Everyone apparently was in that leg banking, making, retiring off that 2-minute leg down on SPY, and you missed it, right? You got to just throw it out the window. So I think controlling those emotions, when you miss moves like that, you have to be able to have a clear head going into the next trade. Okay, that's number 1. Number 2 is going to be risk management. Risk management, we're going to focus on it tonight. Again, these are my answers. It can be different for you. This is what I find the most difficult, or what I found the most difficult. And I think I have found my solution, at least for risk management. And it's not oh, 20% stop loss every trade. Guys, it's not that simple. We're going to dissect what does it really mean to have proper risk management tonight. And I'm going to dive into my thought process, and we're going to run the physical numbers here tonight on my risk management and why I have certain rules in place to, be able to be as profitable as I can. All right, so emotions and risk management, I think, are the most difficult. We'll flip over to the next slide, though. So you might be thinking with risk management, right? Where to start? Where to start? First of all, I'd like to say, don't be a sheep. I really want to get in the mindset, and this is not like a dig at any one of, because I'm a retail trader as well. I started with the $1,700 bond. You guys know the story by now, and turned it into what I did. I've done it all. I've made my money through trading. Don't be a sheep. That's where we want to start. What does that really mean? Well, I'll dive into it. Who wins most of the time? Okay. Who do you guys think wins most of the time in the market? I'm saying these guys, these players right here, institutions, the big money, MMs, algos, computers, right? So that begs me to ask you all the question, right? If these guys are winning, who the hell is losing? Who is losing? The retail, us, the sheep, right? We are the bag holders. We are the ultimate bag holders for the market. Say what you want. There are plenty of people who are successful and have had success trading that are retail traders. I put myself in that category. But listen, what if we can enhance our odds? We can think differently, right? So what I want to do tonight, again, is really focus on developing a trading model, right? When X happens, I do Y. Why? Why might I say this? Well, think about the institutions. Think about the big money. Think about the algos in the computers. They're programmed. They have models, right? Yeah, they definitely adjust certain things on their model, but they're not going into a trade and making emotional decisions every single day. They're not seeing a 5-minute candle and it's like, oh, it's a shooting star candle, so I'm going to just, completely invalidate my idea, right? They're putting extensive thought into these trades beforehand, right? They have developed models that they calculated win more than they do not, right? And of course, there are some funds and stuff that we've seen blow up, right, that were mismanaged. But, a lot of the big boys, they've been successful. And, you think they're making emotional decisions on a day-to-day basis? They're trying to use math and, fact, right? They're not trying to base decision-making off of, oh shit, 5-minute candle, that one looks a little bit bigger than normal, so we're gonna get short here, right? It doesn't make sense, right? So we have to try and shift towards a model structure. Okay, so like an example, and this is not what we're going to talk about necessarily tonight, the model itself. When X happens, I do Y. I have an example. So say the golden goose strat, one of my strats, right? I've calculated, I have back tested this seriously, like over a 90% win rate. It's such a rare setup. So yeah, it's like, it looks like, oh, coach, why wouldn't you take that every time? I saw one golden goose the entire month of October, right? So I'm not going to only trade that if I get one trade, right? That's just a little unreasonable, but just for example's sake. So say with a model would be like, when I get a golden goose setup, when I get a certain, when my model is checking the boxes, and again, we're going to talk about my model in week 6. It's going to be like 3 or 4 steps to take a trade. I add 10,000 premium size every time with a 10% risk, right? And that there's a defined risk factor there of $1,000, right? If I just took that every time, I know I will be profitable, right? So why do we not do something like that every time? You guys, I'm sure you've noticed like certain things in the market. Every single one of you knows ways to win in the market. Your problem comes with risk management. I would guarantee you in the comments right here, we're going to get a couple people feeling like I'm calling you out, but I guarantee you have a $100 day, a $200 day, and then you lose 1,000 the next day, right? It's 2 steps forward, 10 steps back type of thing. And it's because you don't have true structure. And that's what we're trying to do here, is develop a trading playbook. And everyone's playbook is going to look different. Mine is not going to be yours. Yours is not going to be mine. Yours is not going to be the guy, the other guy in the Zoom or lady in the Zoom, right? It's not going to be the same as anyone else. Okay, so now I want to encourage that we try and think differently from retail. Think differently from the EMA grabbers and, there's a key level there, I'm just going to grab puts there. We have to have maybe a little bit more structure and try to think like these guys who are making money. What are they doing differently than us? Well, they're doing extensive research. They're using models. They have everything mathematically calculated. I mean, I wouldn't say every single one of them does, because we've seen some blow up, but most of them do. And that's how they have success, right? So think differently. So step one tonight, trading playbooks, right? As I keep mentioning, teams don't show up. So if you compare this to football, right? Teams don't show up unprepared on Sunday. You don't see Belichick rolling up to play the Dolphins and they haven't practiced. They haven't ran through the playbook. They haven't watched some tape, right? Same thing should apply to trading. You come in, you got your charts ready, you got your strategies ready, but you should have your risk management ready as well. Right. And that's something a lot of you guys, I guarantee, don't write down. And we're going to write it down tonight. We're going to write down the fucking numbers. Okay. Number two, trade as unemotionally as possible. Take the emotions out of trading. So we're going to think differently tonight. And we're going to take the emotions out of trading. We're not going to look at a low volume, but a candle that looks big on our screen on the 5-minute chart. You have the 5-minute chart pulled up. Oh, that looks like a big candle. Right. And then what happens? It gets completely eaten up in the middle of the day. It's 12:30 p.m. on a Tuesday. You get a big $1 red candle, then it slowly gets eaten up. Everyone just gets chopped around, right? And what you do is you chase because you see a big fat red candle, right? You're making emotional decisions, okay? You see a leg down, you didn't have a level, you didn't have a setup, but you still chase to take it because you have such bad FOMO that this is going to be the one. This is going to be the time the market crashes. This is going to be the time where we get a leg down $5 on SPY. I mean, yeah, once in a blue moon, you'll be right? So we're going to try and trade unemotionally and try to get as robotic and mathematical as possible tonight. Again, this is about the big guys in there, those two little bullets, what they have well thought out trades. They don't throw, think about this. They're not throwing around 10 million based on an EMA or, that's a 5-minute candle. It doesn't look like it's going with my side. They ask themselves, hey, is my plan still intact, right? Is the reason I entered the trade still valid? Those are the reasons that these guys stay in trades. They're not basing it off of, oh, I liked it a second ago, but because of the way that this candle looks, I suddenly don't like it. And yes, I do think that Japanese candlesticks are valid. And if that's a part of your trading, great. But just think bigger than that. Okay. And number three for tonight, run the numbers. I keep mentioning this, the math. I wouldn't say I'm a huge math nerd or anything. I think it's important. I really just think this is important. And I've worked with so many people. I've had some boot camps in the past. I've worked with people on the side for mentorships for free too. Plenty of people, hundreds of people, probably thousands of people. And so many of them weren't running the numbers. I mean, it's so important. This can just you can physically see pen to paper, right? Where can I mathematically get an advantage? It just makes sense to do this. Okay. So do some fucking math and put yourself in the best position to win. That's what we're doing tonight. All right. Before we do the math though, and hit on my rules, I want to talk about the 3 biggest trading syndromes, I'll call them. Don't catch these trading syndromes and ask yourself if you have these. There's 3 of them, okay? 3 of them. Number 1, the hope effect. Really, really key. I guarantee you some of you are doing this. Okay, so the hope effect is essentially you take a trade, it breaks your support, it breaks your level, right? You entered for, I'll go into an example in a second. You broke your level. But then you stay in the trade. And you basically abandoned your original plan. So why are you still in? Okay, so let's work through an example because I think numbers and examples resonate and are just better delivery methods for you guys to retain. So example, Look right here, this chart that I provided, arrow to the area I want you guys to take a peek at. Initial add for reject. So what does this mean? This means that in this circle, I added for a rejection, okay? So this green line was my key level of resistance. I added because I wanted this to get a sell-off. And you'll see this 3 5-minute red candle pattern actually did reject right here. I don't know if you guys could see my mouse or not, but those 3 red candles rejected the green line originally, and it actually got a little bit of a sell. But then what happens? It wasn't a massive sell, right? And it comes back over the key level, okay? So what happens with the hope effect a lot is people add right here, right, looking for this green line to reject, and then the trade starts going a little bit above, right? Or hanging around too long, right? And then it breaks out, it breaks over. What people do now when we're here, the hope effect is essentially you didn't stop out like you were supposed to. And then when you're right here, you see this candle and you're like, okay, well, I'll stick with it. All this time, right? Slowly retest, doesn't get back to green on the trade, right? You bought puts here, got all this theta decay. It's going against you. It's also above the price you entered at. And now you've lost value on the cons from theta, and it's still above where you bought on the underlying asset. The underlying meaning, the price that SPY, say this is SPY. If SPY was at 400 here, SPY's at 400.5 right here, and it's going against you. Okay. So it broke my level, and my plan was this. But now, since it's going against you guys, what you do is you look for an average down spot, right? So then you're like, okay, well, it's only down 15%. I can afford an average down, and we'll get this back to even, and then I'll go about my day, right? What you do is you add, then I have another fib right here. Okay, I'll just add my second half right here. Now all of a sudden, it's right here. You're down 20%, and you average down, right? Look what happens. It breaks again, and the hope effect is you were supposed to buy puts here for this to reject, but now all of a sudden you're changing the plan as it goes against you, and that just doesn't make fucking sense, right? It just doesn't make sense. You're changing your own plan that you made before, right? So you had a predetermined risk beforehand of, okay, I'll stop out about here, about 15%, right? Now, instead, you're down 20% and you take an average down because you're like, all right, well, that's, I might have just been early and I do have another big resistance here, right? And then what happens is it goes against you again. You're like, holy shit, like I'm kind of like spiraling here. And then what people say is the last time they'll say, well, it's already down 30% here. I'll risk another 5% to see if this last level rejects, right? Okay, so now you're just basically, the hope effect is essentially, you add for a reason, and as soon as it doesn't go according to plan, you latch for biased, keyword there, biased opinions, biased views as to why you should stay in the trade, right? You look for reasons to stay in the trade. Okay, so, you're down 10% and you're looking for another last hope, right? Which would be this key level. Then you're down 30%, looking for another piece of hope right here. And you start grabbing reasons. Oh, well, I got in for the 400 level to reject, but I also have a fib at 401.38. I also have VWAP overhead. Let me give it another 5% of room. And now, while I will say it is okay, in my opinion, to give room on trades, right? But it's more of the principle of when you enter a trade, you have to have a predetermined plan and a predetermined risk, right? And if something doesn't start going according to plan, then I immediately, personally, I will cut. Okay, and this has been the number one key is little shit like this right here. When it goes against me, I don't care if, look at this right here. This, we're circled. I don't know if you guys can see my mouse again, but you see the end of the circle to the right, the green candle that kind of closes over the green line and then it immediately comes back under. right? I've had trades in the past where my rule was if it closes even a penny above the fib, which you see that green candle closes over the green line, and then it went back under. Like there were instances where I would just take the stop out there and then the trade will work. It's okay though, because my thought process was, hey, if this is really going to be the top of SPY, there's going to be plenty of other entry points, right? So hope effect, don't catch this trading syndrome, grasping for reasons to stay in the trade, guys. I know some of you do it. Just if you do it, it's okay, but recognize that you're doing it. Okay. When I enter a trade, I want 400 to reject. If it goes to 400.5, I'm out. Don't care. Oh, VWAP's there all of a sudden. Mo Mamba, right? Some of my other head traders are on voice. Well, coach, I have the golden fucking duck strategy overhead. It's a lock. No, I don't give a shit. My rule was that I don't latch on to reasons after a trade goes against me to try and convince myself to stay in the trade. I don't. That doesn't fly. Okay. So this is super key. Are you doing this? All right. Moving on here. Okay. Did one more right up here. The hope effect is those who add for one reason, then when it goes against them, they look for another reason to stay in the trade. So essentially it's wishful thinking, right? That's how I gave it the name, or hopeful thinking, right? And I will also point out the funniest thing with the people who do this, and including me, I've been there, is what they do. You see maybe a head and shoulders on one time frame, but they'll find the inverse head and shoulders on like the 1 minute or something. They'll find the little like high or low or something. They'll find something to make a case to stay in the trade. It's ridiculous, right? It's ridiculous. And you're always going to have a reason for both sides. You're always going to have, oh, this is sport. This is a Japanese candlestick. This is the bullish bat. I don't fucking know. There's always going to be a reason to stay in the trade, right? So you got to try to stay unbiased here. All right. Number 2, the blue ball effect. And I've talked about this one before, but I got to go over some old stuff as well, guys. If you've seen some of this stuff, this one is so important. Let me ask you guys, what was your biggest potential gain on something that you sold early? So for me, it was, number 1 was AMC. AMC, I had 10,000 shares at $2.19. I sold it. I got filled at like $2.1890 somehow, I think, or maybe I'm lying. Not lying, but maybe I'm wrong. And it was like $2.18. I remember losing $10 on it, but I had 10,000 shares when it was still a penny stock. Obviously, that ran the next day to like $5, right? That was when the day before it first pumped, like really crazy. The other one I had Lucid call options last year, and I had 100 at 15 cents or 20 cents, and they closed the day like anywhere from $7.50 to $10, so it was worth like $75K. And I just paper handed the shit out of it. Right. So I'm sure that when I asked that question, what was your biggest potential gain on something that you sold way too early, right? It strikes, it definitely clicks, and some memories pop up, basically, right? So the blue ball effect, what is it? Traders remember, essentially, this is like a psychological thing. Traders remember the 1 to 2 big winners that turned around if they had held. They love to latch on, including me, right? We're all grouped into this. They love to latch on to the 1 or 2 big winners that turn around if they had held, right? Forget the 100+ losers. For me, 1,000+ losers at this point that kept bleeding. Probably, I don't know. I don't want to go as crazy and say 10,000, but definitely 1,000+ losers that kept bleeding, right? So basically, you are latching on to the 1 or 2 big ones that got away, the one that got away, right? And you forget about all the other fish in the sea, all the other losers that just little 5-10% ones just that kept going, right? That you did cut, you did follow your rules. And if you didn't follow your rules, those would have been massive losers. So you only remember the winners. So essentially you're giving yourself blue balls there. So this is also sort of a wishful thinking, what do I call it? Like syndrome, where you have those 1 or 2 rare scenarios where something highly unlikely basically panned out. And what that does to your brain is it essentially, it sticks with you, and it becomes a reason. Tell me if I'm wrong here. It becomes a reason. You rationalize it a year later to, hey, maybe this is the one. Maybe this one's going to turn around. I got in a trade once where I stopped out too early and it turned around and it ended up being a 500%er, right? So you use those one or two rare examples to rationalize, the everyday trade, right? And it's just so funny because it's the day before Fed. It's fucking 12:30 on a Tuesday, and you're saying that to yourself, like, oh, maybe this is the one. This is the one that's going to break. No, it's not. It's not, right? It's hilarious. I do it all the time to myself, and I find myself doing it. You got to just recognize it. Does your brain have blue balls from previous trades? Okay. Let's see. Yeah. Okay, I got an example here. Let's see what I got. Example. So last week, we've had a trading range from 380 to 400 for a while now. So last week we had a range day all week, right? And this is really relevant to today's market. You guys, not you guys, but retail, which again, grouping myself in here, what we do is every time it gets up to high a day, it's about to break out, right? But at a certain point in the trading day, like 12 o'clock, if the market wanted to make its move, it's going to make its move usually, not always. Some stuff comes up midday and breakouts happen sometimes late, but usually it's going to make its move early, right? And when we have a range day, it's usually a range day for the whole day until close. If you don't see anything break out early, it usually doesn't always. So blue balls here is basically every time it gets up to high a day, you think something's going to change. And look at this example right here. Okay, so you start on the left, that shooting star, top left, right? Got smoked, bottom left. Then a lower day was put in, right? So then when you come back up to high a day, you don't really know where we're at yet, in fairness, but then it rejects, then it tests again, and everyone's jumping and it calls again, gets smoked. Then it goes to lower day. Okay, well, we failed this. We're going to start, really selling because we couldn't break out. Then it bounces here, then it bounces here, bounces here. Like, look how many times it bounced in this zone, right? So the blue ball effect is essentially, I would argue that forget about the AMCs of the world. You have this from these range days because you remember those one or two legs. Like a good example is probably CPI that came in pretty low. And we had a big breakout and we ran $20 in one trading day, right? Which was like the biggest move in 2.5 years or something on SPY. So you remember that. You remember a range break like that and how powerful it can be. And you think that, oh, well, if it breaks out of this like 390 level, or if it breaks over 400, it's finally going to run to 410. It's going to go right there, right? And we just forget like how often these ranges actually stick. Right. So you remember that one time when it broke out, and instead of waiting for confirmation, you try to get the breakout every time. You try to get it here, you try to get it here. Then you try to play the breakdown here and here and here. You're just getting chopped up. Right. So I think this is very, very relevant. Make sure you're not having blue balls. Make sure you're not latching on to one breakout we had of 380 or the one breakdown we had of 370, and you're chasing every little break up or down. Okay. Looking for those massive moves. It'll come. We'll break this range. I mean, we have a nice range right here. And when it does start really giving, I'll be looking to play it. But just understand what the current market is doing and don't latch on to, something from a week ago or a month ago or a year ago that you saw happen and think it's going to be every single time it touches high days, it's going to be a massive explosion upside. Okay. All right. Number 3. This is the big one. I know so many of you are doing this. Let me just get a quick sip of water. So, ignore that caption up top. I should have deleted that. All right. So, stop loss and profit taking correlation. Okay. So I love examples. I love the numbers. I came up from the retail side of things. I grew the Twitter from just posting plays on Twitter totally natural growth. I mean, I'm not making millions a year, right? I'm just making 6 figures a year. I'm 23. I've been base hitting my way up. Okay. I love to deliver my educational content in a way that really resonates to someone that was maybe in my shoes a year ago or 2 years ago, right? That's looking to learn, or maybe you even, have in-depth knowledge on this and you're just trying to see some examples. I really like examples and numbers. So hope you guys can keep up with this. It shouldn't be too hard. I tried to do like really easy numbers. So example, $1,000 per play, right? Say you're putting $1,000 down on every trade tomorrow. Just say, okay, say I'm putting $1,000 on a couple trades tomorrow on SPY, trying to scalp SPY. I'm looking for 10% gains on SPY each play. $1,000, 10% gain. I'm looking for $100 a play. Okay. Say I hit 3 trades in a row. I think I'm pretty good at trading. I'm not perfect, but I think I can hit 3 trades in a row. It's not something that happens every day, obviously, but it's something I've done before, right? So I think, say I come out tomorrow and I hit 3 trades in a row. Okay. I've been winning, say 75%. I come out, hit 3 trades in a row. I'm up $300. Okay. But now what happens here, guys, and this goes back to 2 steps forward, 10 steps back, right? So I hit 3 trades in a row using $1,000 down, 10% each. So I win play number 1. I get a 10% gain on 1,000. That's 100. Win play number 2. That's another 100. That's 200. And then win play number 3 on SPY, another 10% scalp. And I'm up $300 for the day. Now it's lunchtime, and I'm like, I'm having a good day, so I'm gonna go in and grab another trade. And I always get my ass kicked at lunchtime. I don't know about you guys. I'm killing it in the morning, and at lunchtime, like I'm probably net red at lunchtime for the year, and obviously green, like really nicely green in the morning. But lunchtime is not my time. So yeah, we're up $300 right now. We hit 3 trades. We take a lunchtime trade. Doesn't even have to be a lunchtime trade, but just say for the example's sake. And I use a 30% stop here, right? Now, all of a sudden, I'm back to even. Okay, so what just happened, guys? What just happened? Well, we'll go back to that in 1 sec. People tend to cut winners early and let losers bleed. Okay, so it actually should be the opposite. Should be the opposite. It's really simple, right? Think about how it impacts your risk reward. What just happened? Let's go back now. I just won 3 trades and I lost 1. What's my hit rate there? I'm winning 75% of my trades. Okay, that's great. That's great. Am I buying a house? Winning 75% of my trades? Sounds like I should, but what's my P&L? P&L is what matters, guys. Stop chasing percentages and stuff. It's P&L. I just won 75% of my trades. I have a 75% hit rate. That's better than hedge funds. I'm telling you, I shadowed one. They were hitting like 60%. They were ecstatic. They knew that they'd hit 60% every time with their model. Doesn't matter, right? 75% of the time, these guys, I'm hitting, right? But with this risk management system, with this stop loss and profit taking correlation or lack of, right? I netting $0 on a 75% win rate. So what's essentially happening, well, hold on, let me go back here. Hold on, I apologize. Okay, so what's essentially happening, people are doing what I like to call taking unlimited losses and limited gains. And you guys see green, you see green and you kind of shit yourself a little bit. You don't even know, you're surprised. You're like, oh wow, it's green. Like I got to take some profits before this thing goes red, right? And that's just no way to trade. You don't have a proper RR with that mindset. And this is why a lot of you guys, including me, I've done this so many times. This is where I have come up with this. And really, when I wrote it down, I figured out this was the problem. Okay. Because I was seeing green, and anyone who's in Discord knows me. Like I do have a really high hit rate, but I'm known as like the paper hands guy. So I still struggle with it sometimes today where I'm taking gains a little bit too early, and I'm probably already, yeah, I see some comments already. These guys mess with me. But yeah, I still struggle with it today sometimes. It's definitely something that's hard. But once you write down the numbers, it becomes a lot easier. And guys, you're gonna write this down. And you're gonna be like, wow, like what am I doing here? I guarantee you, a lot of you that are red on the month, on the year, whatever. Guarantee a lot of you are winning more trades than you're losing, which is like this screams out at me. Hey, you have a problem with your risk management. You have a problem with emotional decision making, right? You have no math. You have no structure in your risk. Okay. So again, example, $1,000 a play, 300 on 3 trades, lose one, and boom, and better yet, guys, what some of you do, 40% stop loss on that last trade because you're like, oh, it's red, like you get the hope effect, and you let that go 40%. So now you're 3 for 4, 75% win rate, and you're down $100. Just makes no sense, right? And you really have to just, if it's you, just admit it. That's fine. It was me at one point. Still is me sometimes these days, but at least I recognize it and I know how to fix it. Okay. So if you have a problem with any of these 3 trading syndromes, that's okay. This is some of the most common shit I see. And the good news for you, the most fixable thing. Any of these 3 that you just saw, the hope effect, the blue ball effect, stop loss, and profit taking correlation, these 3, totally fixable mistakes and very common. But a lot of people just don't pick up on it. I'm telling you, the 2 steps forward, 10 steps backwards thing could be more relatable. I mean, I see it all the time. Okay. And what happens is a lot of people sometimes, like the problem for me is when I get on a hot streak, like anyone remember how I had 25 winning green alerts in the Discord in September. And I ended it with almost a $4,000 loss on Tesla. Right. And it's just like, I was still nice and green on the month, but it's just like to give back $4,000 on one trade was really because I just got cocky because I was winning. I felt like I had the hot hand. I felt like I figured everything out. And then the market just, boom, humbles me just like that. Right. So whether you're a beginner and you're struggling with, more of the basics, or whether you're experienced, maybe you're just getting, in your own head and you're thinking, hey, I'm better than the market. Like, it humbles me all the time. So I hope you guys get some takeaway from those 3, but now we're going to move on to the risk management. Give me 1 second. Just got to turn my air down. All right. How are we doing so far? Let's do a check-in here. In the member chat, how we doing? Everybody still with me? Not putting you to sleep? If Dwayne was presenting, man, oh my God, I'd be knocked out right now. That man should be giving out Starbucks gift cards with his sessions. Try to stay awake. Holy shit. Can I go back a slide? Yes, guys. 1 sec. I'll go back a slide. And I can make this all available for you. So I'm going back a slide for someone. And any questions before we move on? We're gonna get into the numbers now. I know you guys are itching for that, especially the trading playbook guys and ladies. Doing well, still newer here, so wouldn't mind hearing your 1,700 bond come up story after the lesson. Yeah, so, and listen, like I will be the first to admit that 2020 was obviously easier times to trade. But I basically cashed out all the money to my name to pursue trading after I shadowed at this hedge fund. I was like, this is insane. Like, this is what I want to do. And I just wanted to get involved. So I had to start small, started out with the small caps, just poking my head around. I had done paper trading accounts on large caps that I turned like $1 million into 90 million. It was paper. I just bought a shit ton of Tesla on this Investopedia challenge. So that was a good way to like learn the basics. But the $1,700 bond, I started with like smaller stocks, and what basically happened is I turned 1,700 into 20K during the whole like COVID hype thing. And when that kind of died, I didn't get smoked, but I went from like 26K to 20K. And I just, for 4 months, my portfolio just consolidated from 20 to 26K. And I couldn't bear it. I was like, I got in the COVID run. It was very easy. And I'm just going to take my money, be happy, and go about my business, right? So that was that. And then Diamond Trades actually was doing really well with options with Mander. And they were like, dude, you got to get back involved. You got to get back involved. Like, so December 7th of 2020, I just got back involved, and I was like, I'll go full here. Invested all my time into it, and, was able to, without trading AMC, by the way, because I sold all my shares, but, with Trade and Spy, VIX, VXX was one of them that I made a good amount on, but yeah. So I took that to, I don't know, with taxes in New Jersey at this point, definitely hindering the growth. But I made 250 last year and hoping to get close to that this year, but we still got a little time left. So it is possible. It is possible, right? Even when the market is slow, they tell you, hey, retail, you guys got to go. But I don't think so. I don't think so. There's plenty of people that are making money in this market, and it can be any of us, right? All right, let's move on though. Let's move on. You guys got that slide? All right, cool. All right, so we're gonna dive into my rules, and just disclaimer here: my rules are not your rules. These are my rules. If you want to use the same rules, by all means, do what you got to do. But at least what I want to do, or what I wanted, was for this to sort of get your brain moving, right? And just get the ideas flowing for yourself. And also, I have obviously a lot of examples in math going in here. So number one, and this goes back to the hope effect, right? What went wrong? What went wrong with the hope effect, right? I have a plan and I stick to it. This is the number one rule I have. And I have a trading playbook, right? We're talking Coach Dipka. I have a trading playbook. Play number one, have a plan, and I stick to it. That's my go-to bread and butter. When I have a plan, I stick to it. Okay, to just dive a little deeper into this, we're not going to spend too much time on this. If my plan starts going the opposite way, guys, I immediately cut. That's my number one rule. That is the number one rule for me, and that is the number one reason why I think I have really avoided some big bags in the past where I think others have not. And well, I have an example at the bottom. I'll show you. Okay. But basically, do not allow the hope effect to kick in. Okay. Example. I bought SPY puts at 400 for a support bounce. No need to stay in the trade, right, when it's down 3 to 399.50. Well, I will say this. People play supply zone. So yeah, listen, if your plan was to buy puts from 400 to 399.50, sure, I'll stay in the trade if that was my plan beforehand. But whatever the plan is beforehand, I need to stick to that. If my plan was 400 is supposed to work, I'm not supposed to stay around when it's down, right? So like a good example would be you have a candle close at 400, but you have the candle wick at 399.50. And this is where the hope effect comes in. People will buy it at 400 on the candle close from, like, say yesterday's low was 400. And that's the candle close, but the wick was 399.50. People will buy it at the close at 400, and then it'll wick down to 399.50. And it's like, yeah, it's valid to maybe stay in that trade, but what happens if 399.50 kind of breaks fast, like all of a sudden? And then this is how people end up really bagged, is they buy here with, under 399.50 as a stop, but they really loaded their full position here, right? So essentially, my first rule here is when I have a plan, I stick to it. If I want 399.50 to be an ad spot, also with 400, that's fine. But what this does is it tells my brain, hey, I have a risk tolerance to $399.50. If it goes to $399.50, I'm cool with adding more. If I tell myself that before the trade, remember, before the trade, you're not emotionally invested. This is why this is key. You're not emotionally invested in the trade when you don't have any skin in the game yet. So you make a lot more rational decisions before the trade than when you're in the trade. So that's why right before I enter the trade, some of you guys should even just write it down. Hey, this is my plan. I'm going to buy it at 400 and I'm going to stop at 399.25. I'm going to take profits at 401, right? Write it down. Just write it down, because when you get in that trade, the emotions kick in and then you start making those flawed decisions, right? Because now you're emotionally invested. Now you have, a P&L that looks a little bit red, and you don't want it to be red. You don't want to be wrong. Okay. So to continue with this, so as I mentioned before, right? Say 400 was my support, it broke, I bought. Now it's down at 399.50, but I was looking for the bounce at 400. If I didn't get the bounce at 400 as per my plan beforehand, I was like, 400 is a really key level. It's a massive level. If it even starts going below, I don't want to be involved. If I said that to myself before the trade, well, if they bring it under to 399.50, stop it and then close it back over, and it's going to be that $20 rally spot, guys, that some of you like always tell yourself it's going to be, oh, well, they just stopped me out. Now they're going to rip it. Now they're going to do it. Now they're going to squeeze them, right? Well, if that's true, there's going to be other entries. If that's going to be the low before the $20 rally or the $10 rally or the squeeze into close, there's going to be other entries. You got to just tell yourself that. So this rule is very important. And I will say, cutting losers has been the number one key to my success. Why? Well, let's go back, and I'm not going to like bullshit you guys. Let's just look at a real example. Okay. So net gain in 2021 for TD plus Webull was like around 252K. So that was my net for 2021. Short-term gain was 1.252 million. Some of you might be like, no, I didn't make 1.2 million. That was all my gains added up combined for the year on this account. Now, if you go to TD Ameritrade, it'll actually show you. Just go to the tax center, and you can look at your reports down on bottom. And I pulled mine here from 2021, which I've shown before on Twitter and other classes. Short-term gain, 1.223 mil, right? And then, but what's that number in the middle? Short-term loss, right? And then that's how you get your net. So you take your gain against your loss for the short term, and then you get your total net, right? So I lost all my losers combined, added up to over $1 million for the year. Pretty fascinating thing. So if I didn't lose a single trade, I would have made 1.2, right? Obviously, that's impossible. It's not going to happen. But that number does grab my attention. It makes me think, hey, how can I just, what's 10% of $1 million, right? It's 100K. What's 5%? That's 50K. Fuck it, like 2%, 1%, that's 10, 20K. So that number really grabs my attention. Short-term losses, I lost $1 million worth of trades. That's pretty bad. I mean, I wouldn't say it's bad, right? Because I have the net gain against the loss, price you pay to play, right? But it does grab my attention and makes me think, hey, check the bottom out here. Just think about those, the extra 10% that you let those losers bleed, the extra 10% that goes against your plan, the extra 10%, you grab on an earnings lotto. And obviously this is going to be relative for everyone. You got someone like Dozer, whose report is probably triple mine, right? Probably add a zero for that guy. Some of you, it might be small, but it's all relative. The money at the end of the year, it doesn't look like it on a day-to-day basis, but let this be your sign that when you have a plan and you don't stick to it, it may seem like $10 here. It may seem like $5. It may seem like $100 just for the day. It might not seem like a big deal for some of you. Add that up over the course of the year and see what happens. Add that up over the course of the year and take a look at, hey, if I had just, listened to Dipka and I was sticking to my plan and not letting shit bleed out, that's an extra 100K in my pocket, baby. Right? That's an extra 50K even, 20K, it doesn't matter, right? That's money I want to have, and I'm just giving it away. And what I calculated, guys, was I was losing about 70% of my trades during lunchtime, right? So I just think like how many of, if I just cut out lunchtime, right? Just makes me think like if I cut out trading at lunchtime, I mean, what would this P&L look like? It'd be maybe a lot different. Okay. So take a look at this stuff, look at the numbers, and, you know, before you ask yourself, where can I go to win? Ask yourself, how can I prevent losses? Where can I look to prevent losses? Okay. All right. Rule number 2. We'll try to get through these a little quicker. Hope I'm not going too slow for you guys. Find your true risk tolerance. This is essential. Your pain point. We're going to use the word pain. We're going to use the phrase pain point here. Okay. So I want you guys to ask yourself right now, at what dollar amount when you're red does it start to hurt in a given day? For some, it's all, guys, it's going to be different for all of us, right? For some, 100, others 1,000. For Dozer, it's 100K. You know, whatever it may be, you need to identify your own pain point. Okay. So I want you guys to picture your brokerage right now. Close your eyes, visualize it. It's a red day. It's a red day last Friday. Your P&L shows a figure for the day. And as I'm saying that, right, what dollar amount comes to mind? What dollar amount makes you emotional? Where basically, if you lose on the next trade, so it's tomorrow and you're down on the day, right? And you're kind of at the brink of like, hey, I don't want to really lose more than this for the day, or else I'm kind of like, will be, you know, affect the rest of my mood for the day and make me make maybe emotional decisions into the bell, right? Where you're kind of scared. You're like a little scared going to the next trade. Yeah, it looks like a decent setup, but if I lose another one, man, like that's going to be really bad. What dollar amount is that, right? That's your pain point. What's the max loss you will mentally allow yourself to handle in a given day? Okay. So for me, guys, that's going to be, I mean, if I see anything over $1,000, I'm like starting to get there. About 2K is really my pain point. Like that's where I'm like, damn, like this sucks, right? I can handle a 2K loss, but anything that kind of goes over that, I'm like, wow, I really fucked up for the day. So you have to be able to identify what this number is for yourself, okay? Because without that, you just can't know what stop loss to use. You can't know, you know, what amount to risk without this pain point being identified. Some of you are going to be like, oh yeah, like I don't mind losing 1,000 in a day, but then when it gets to 500, you're like kind of shaking in your boots. It can't be that way. That means maybe 500 is your pain point. So really try to pinpoint what your actual pain point is, your true risk tolerance. Don't lie to yourself here. Your true risk tolerance, okay? And as you guys are going along with these slides, I would encourage that, you know, maybe try and make your own trading playbook find these numbers, write this stuff down, and then kind of the idea is to come up with your own sort of risk system here after tonight. All right. And this number, by the way, in my opinion, should not be more than 75% of the daily goal. So we'll talk about daily goal in a sec, preferably about 50%. So say my daily goal is 4K, right? You know, I don't want my pain point to be more than 75% of that. So more than 3K. Right. And the idea of this is, again, just doing the math. You want to give yourself a positive RR, right? Just like you would in a trade. You don't want to be risking 3K in a day to make 2K. Just simple, right? So really identify your true pain point here. Number three, rule number 3 for me, determine a realistic daily goal, right? As we just mentioned, the daily goal. This should be achievable 3 to 4 out of the 5 trading days per week for you. Okay. So, you know, do not go put up 1K if you've been making 400 for the past 3 to 4 weeks. So you have to be able to identify what a realistic daily goal is for yourself. It's going to look different for everybody, but my daily goal, I'm not going to write down, hey, my daily goal's, you know, 100K if I've been making 1K a day, right? make it something that you're able to achieve. You're not going to achieve it every day, of course, but something that realistically, and again, doesn't mean you have to achieve it every day or it's going to get done, but that's realistically achievable for you 3 to 4 days of the week. Okay. And you're going to have red days, of course, but this number is important for later. And another rule that I have, like a kind of a sub rule or subset to this slide, is I stop trading at 50% of my daily goal. So if my daily goal is 4K and I'm down $2,000, or if my daily goal is 2K and I'm down $1,000, okay, I'm down $1,000 right now and I'm usually trying to strive for a 2K day, I'm stopping trading right there. Okay. And what does that mean? You know, for newer traders, when I was newer, I definitely like to stop for the day just because that was mentally what I could handle. But I feel like I have seen enough shit and I know when I'm being irrational and emotional, and I can control that to a degree. So what I like to do is, at the very least, if I'm down 50% of my daily goal, automatic, I have a Post-it note on my monitor. Walk away. Just walk away for a sec. It's all good. Get a glass of water. Something simple. Clear the head, right? What is the purpose of this? Well, guys, essentially, we want to construct a risk management system that is impenetrable, okay? So if my daily goal is 1,000 and I lose 500, I will generally stop trading, especially if new, like I said, so those emotions don't kick in. And what is the purpose of this? Again, impenetrable. Think of that phrase, impenetrable risk management system we want to create. What is the purpose of this? Okay, the purpose is, if I hit my daily goal of 1,000 on Monday, right? Say my daily goal is 1,000. I hit that on Monday, but now I'm down 500 Tuesday, right? And that's 50% of my daily goal. So my rule is, hey, I'm down 50% of my daily goal. I got to stop. I got to take a breather, recollect myself. I'm still net 500 for the week, right? And what does this also do? What does this also do? Well, look at this bottom bullet. Think like this. In this same scenario where I win 1,000 Monday and I lose 500 Tuesday, you can actually shift your mindset to thinking, hey, I'm actually up 250 a day for the week. Okay. Now think like this. Say I hit my daily goal on Monday. I lose 50% of my daily goal on Tuesday, and I lose 50% of my daily goal on Wednesday again, or on Wednesday as well as Tuesday. So I'm back to back losing 500 Tuesday, Wednesday, but I made 1,000 Monday. I'm still flat for the week. So what does that mean? Now think about it like this. Remember that example we had where you were 3 for 4 and you were break even? Well, now you're 1 for 3 and you're break even. So now with this math, right, with this risk management system, you're now hitting 33% of your days and you're still flat. So you're less than 50% and you're not red, right? So we're getting there. You see where I'm going with this? Before, we were 75% win rate with zero return. Now we're at a 33% win rate, right? With this simple rule change, just a simple rule change, right? We're at a 33% win rate and we're flat. So our win rate is down over 50%, right? It's down over half of what it was before at 75, down to 33, right? We lost half of that value, but we're still sitting at even. How amazing is that? Just one simple rule change. See, the thing with you guys, you're not doing the wrong things. You just have 1 or 2 little things that you need to tweak. That, like, you're looking in the wrong places a lot of the time. A lot of time, the answers are right in front of you for what needs fixing. It's like 1 or 2 of these little rule changes or just little tweaks to a strategy, I swear, just makes leaps and bounds of a difference. So take with that what you will. But again, Monday 1,000, Tuesday minus 500, Wednesday minus 500. Okay. Say Thursday minus 500. Okay. So now I'm down 500 on the week. All I need to do on Friday is hit my daily goal, right? And then I'm still profitable for the week. So now say I win on Monday and Friday and I lose Tuesday, Wednesday, Thursday. With this risk, I'm up 500 for the week. I'm 2 for 5 and I'm positive. I'm 2 for 5 and I'm positive for the week. Okay. So I hope this makes sense to you guys. I hope it, maybe helps you rationalize things and makes you think a little deeper about your risk system currently in place. Again, we're going to get into it. I'm just going through my rules first. All right, rule number 4, only got 4 more. I must have a predetermined risk in every single trade. Kind of went over this, but I want to dive a little bit deeper here. So every trade I enter, I have a max loss on the trade that under no circumstance will I let it exceed. And I really try to be firm on this rule. Of course, I have this rule written down. Sometimes, shit happens. I don't always listen. I should, but we're people, we're humans. We make emotional decisions. We can't resist the temptation sometimes. Try to follow this as strictly as possible. So that phrase, impenetrable risk system. How can I give myself the best chance to profit with stop loss? So we're going to get into stop loss now. Okay. So example, I have a pain point of 2,000. So say in this example, my pain point is 2,000. What's my risk per trade look like? Okay. So say Coach Dipka's risk or max risk for the day or his pain point is $2,000. That's the most he's willing to lose before he gets emotional, right? I encourage that we run the numbers here. So let's do it. Note to self. Stop using a stop loss percentage and shift towards a dollar amount. You guys walk away with one thing. It's going to be those 3 syndromes. It's going to be one thing coming later, and it's going to be this. Stop with the stop loss percentage bullshit and focus on the dollar amount. Let's just do some freaking math, right? Are you trying to make money or are you trying to just show off Webull cards? Ask yourself. You can't go to the Lambo dealership with the Webull card. It's not happening, okay? So I take about 3 to 5 trades per day personally. So I'm someone who takes about 3 to 5 trades per day. My pain point is 2,000. And this is kind of true. This is kind of actually the reality of my situation here. I have a pain point of about 2,000. And I take about 3 to 5 trades a day, depending on the market conditions. Can't say for sure, but 3 to 5 trades a day, that's going to warrant somewhere around 400 to 500 per trade that I want to risk personally, right? So think like this. If I lose 5 trades in a row and I'm risking $400 a trade, I lose 5 trades in a row, I'll hit my pain point. That's where I want to get my risk management system in line with that type of a number or that type of a sequence. Okay. Think about it like this, guys. Think. Let it be 4 or 5 losers in a row that takes me out. This means that with these numbers in place, instead of a stop loss percentage, right? We'll get into the stop losses in a sec. I'm thinking about it as what amount of money am I risking? Do you think that I, Coach Dipka, am going to lose 5 trades in a row for 400 a pop, right? If I really followed this number would maybe hit twice a year. I'm not losing 5 in a row. I mean, maybe once this year, maybe, right? At least when I make rational decisions and stick to my rules, right? The problem is I have gotten away from this and I have exceeded this number plenty of times because I've gotten away from these rules. But if I really follow these rules and I'm risking 400 a trade because my pain point is 2,000, and again, these numbers are going to vary for you guys. But say you're taking 2 trades, right? Then maybe these numbers shift a little bit. I don't know. But I want to give myself as many chances as possible before this pain point is achieved. So let it be, and I don't think it has to be 4 or 5, but let it be at least 3 losers in a row before my max loss for the day is hit. The problem with you guys, and I'm not calling anyone out individually, just the problem with retail, myself included, especially in the past, is, we're letting the pain point get hit after one freaking trade. It just doesn't make sense. We don't give ourselves a chance. Oh, I lose one trade at 9:35. They grab my stop. I'm down my pain point already. It's 9:30. We're 5 minutes into open. My pain point's already hit. That should not be the case. Let me take 4 trades and see if all of them stop out, then I'll hit my pain point. That means I got to work on something with my strategy, right? Let the strategy be wrong, not the risk management, because we can control this. This is what we can control the most, right? So I like to use this example. So guys, I posted this on Twitter once. Give me 100 trades, and I can say with certainty myself that I will win 50% or more of those trades, right? If I were able to pick, 100 trades on SPY in a row, I know that in a sample of 100, I'm going to win over 50%. You give me one trade tomorrow, hey, Coach Dipka, give me a trade. I don't fucking know if it's going to work. I mean, I obviously have confidence in my trades, but shit happens. News candle, who knows? Level didn't work. Who knows, right? Give me one trade. I could be hitting technically 0%. So why are you guys letting one trade dictate your day, your week, your year, right? Give me 100 trades, because I know that with the proper risk system in place, it's going to be fucking impossible to stop me. It's going to be impossible to take out my port when I'm using this proper risk system, when I'm running these numbers, right? I have 4 or 5 chances to not let this get hit. Okay. And on the other end of this, by the way, we're talking really about stop losses and risk here, but we'll dive into week 6 about the upside, right? Where you lose 4 trades, you're down 1,600, 400 a pop, you lose 4 trades, and then you hit that one trade, and with the proper, strategy to the upside, you only need one winner to wipe out 4 losers, right? We'll talk about that later. We're not going to get into that now, but I just hope this is making sense to you guys. I think this is a really good perspective and way to sort of just lay out this information for you guys. Give me 100 trades and I will win over 50, right? But if you give me just one, I might lose 2,000 right here. Give me 4 chances. And I don't think that number's going to hit. All right. Rule number 5. Oh, wait, actually, I got an example for you about stop losses. So say for futures, I have a futures one and an options one. I'll go through these really quick. So for futures, 1 point on ES is $50. Okay. So for my stop losses, I like to think about it like this. Instead of using, hey, I'm going to use 10 points every time. Well, you're buying different contract amounts, depending on the day, depending on the environment. So why are you basing it off of a number stop loss or a percentage stop loss, right? Think about the dollar amount. So if I'm trading ES and I buy one con, and remember 1 point is $50, then when I get into ES long at 3,990, I'm going to use a 10-point stop. My risk is going to be $500 a trade. I have that predetermined risk beforehand. Okay. If I buy 2 contracts, I'm not going to use the same 10-point stop loss because I'm running on a risk based on dollar amount, right? Because dollar amount is what matters at the end of the day. Okay. If I buy 3 contracts, I'm not going to be using a 10-point stop. I'm not going to be using a 5-point stop. What's my risk? I know my true risk is 500. I don't want to lose more than 500 on a trade. Okay. So I'm going to use a 3.25 point stop loss. So this is how I think of it, guys. This is how I think of it for risk. Fuck the stop loss percentage, because you throw 10 contracts one time and you throw 20 another and you throw 100 another and you throw 1 another. So it's like, oh yeah, I won 4 trades, lost 1. The biggest, of course, the one I lost is the one I threw the most contracts on. I hear that one all the time too. Well, if you're using a dollar amount risk instead of a stop loss percentage, makes more sense, right? This makes a lot more sense. But, take away ES, and if you buy MES, and if you guys don't know about futures, it's fine. I'll do an options example in a sec. If I buy 5 minis, I can use a 20-point stop loss. So you get the point, right? Depending on my size, I'm actually risking the dollar amount, not the percentage. Okay, options example. Say the premiums are $1. So it costs $1 per contract, or actually $100. You guys obviously know how options work. I can buy 10 cons, right? I'm still trying to risk $50. So if I buy 10 cons, I'm allowed to use a 50% stop loss. So if I buy 10 cons at $1, right, that's $1,000 down. I can let it go for a 50% loss. Okay. I can buy 25 cons and use a 20% stop loss. Okay. So still risking 500. I can buy 50 contracts, but then I'm going to use a 10% stop loss. Okay. So you guys get the point. And then say 5 contracts, say I scale it back, then I have no stop loss, right? If I buy just 5 contracts at $1, that's going to be a $500 total, total investment down or total premium there. And, you know, that I could let it go to 0 and that will hit my max risk for that trade, right? So I personally throw out the stop loss percentages and I think about risk, because when you run the numbers, you can make it make sense for yourself. All right. Everything making sense so far? Nick Pinto just said, or I'm not sure if his name is Nick, but and Pinto said, what if you use the same size on every trade? Well, I think that's then that the stop loss percentage is perfectly fine, because you'd still be risking the same dollar amount. So yeah, that would be, I think that's perfectly fine. But again, you got to make that decision, you know, if it's working for you. But I think, yeah, it would, you know, if you're risking 20% stop loss and you're putting down 1,000 every time, it's going to be $200 each time, right? So yeah, that would be perfectly fine based on my model. All right. Rule number 5, I always move my stop loss along with my trade. Pretty self-explanatory. So my rule is essentially for anything like not ODT, basically, as soon as I see like 15 to 20%, guys, what I'm doing is immediately setting my stop loss to even personally. And a 10% move or higher warrants a stop loss move, right? So if I'm in SPY calls at $1 and they go to $1.10, I'm not necessarily moving. Say I'm in with whatever contract size. Let's say I'm in with 10 contracts. I'm in with 10 contracts at $1. I'm risking 1,000, and say I have a stop loss at 50%, right? If I see a 10% move higher, I'm probably going to want to move my stop loss up 10%. So that stop loss would move up to like 40% loss or 25% loss, whatever. Once it gets to like around 20%, that's when I'm like, okay, no reason to let this go red. People say, oh, never let a green trade turn red. You got to give a trade some room to breathe. If it's up 1%, and I know I'm kind of hypocritical saying this, if it's up 1%, you know, doesn't matter. You got to give it some room. I could still let that go red because I want to see if my idea is valid. I'm not going to put a stop loss entry then. If I see 15 to 20%, that's usually when I like to let it, make sure it doesn't go red after that, right? Example. So I have 10 cons at $1 on SPY calls. So this is in the Discord. They see me trade like this very often, and it really makes sense for anyone trying to hit home runs. So I have 10 cons at $1 on SPY, right? So I have 1,000 down. It goes up to $1.20, so I'm up 20% in the trade. And then I sell 5 cons at $1.20. So, right, I had 10 cons at $1. They went up 20 cents. 10 cons up 20 cents is $200. I sold half. So I sold half of 200. I sold 5 cons. That means I captured $100 there, right, in profit, which means now my break even, this is another stop loss strategy, my break even can now be at 80 cents. Why? Because I sold half for a 20-cent gain. Now I don't have to necessarily put my stop loss. You don't want to put your stop loss at entry because maybe the cons are volatile. Maybe it's short-term expiration and you want to give the play some room to breathe out. Yeah, well, now what I can do is I can actually put my stop loss at 80, right? And now I bought them at 1 and I'm stopping at 80 and it's risk-free, right? I would still net zero. I would still break even on this trade if it went below my original entry because I sold half for that on that original pop. And this is something I do when I have a really good key level. I love when I have a key level that it may be counter trend. I don't know if it's going to reverse the trend, but you know, I don't like fading the trend, but I really like the key level. I'll take the scalp off of the key level, put the stop loss. Say I captured 10 cents.
Okay, I bought at 1, I sold half at 110. Now I'll put the rest for a stop at 90, and I'll have a free trade. See if it goes, see if it reverses, right? But I'm not, just throwing. Just we'll see in the next bullet actually. If it goes all the way back to 80, worst case or break even, anything higher is profit, right? So now say it goes to $1.50. So I sold half at 120. So I sold 5 cons at 120 from 1. And now the remaining 5 goes to $1.50 here. Okay, which is also high a day. So say high a day was my target, and what am I going to do there? Well, now I'll scale like a quarter, say 2 to 3 of the cons, and I'll keep 2 runners. Okay. So at this point in time, I've secured about 250 with those cons. I put a stop loss to entry and let the last bit go for the crazy move. So guys, what I'm trying to say in this example is I don't hold personally my 10 cons from $1 to $1.50 or $2. I don't hold my full position. I add at my key level. No one really knows if a position is going to keep running forever or not. No one knows how far it's going to go, right? The best thing I can do is manage risk properly and give myself free contracts to run or not, right? And if you're playing with small cons, I get it. This can be a little bit tougher, but even if you're playing with 2, right? Maybe I trim 1 con at $1.20, can put it to 80. And then once it gets to $1.50, maybe I move it up to $1.20 stop loss, something like that, right? But the point is this last bullet. I use house money to take my home run shots, guys. I'm not using the credit card debt money. I'm not using, the money that's going to the rent or mortgage. I'm not using the life savings account money to take my home run shots. I'm using, good risk to reward entries, making them free for myself, and then letting runners try and get that 100% gain, that 200% gain. Okay. That's just me. If you guys, if someone else is working for you, of course, do you. This is just my stuff right here. All right. All right. Rule number 6, quickly, not going to go, we're approaching 10 o'clock. I want to be done in the next 5 to 10 minutes. Recognize dead periods of the market. Lunchtime, basically, guys, I have 12 to 1. I'm no longer trading. Okay. Unless I see an A+ setup, I will not trade, or I will go with what I call Chipotle money. So I give myself like a little, and listen, it's all about the tricks for the brain. Trading is very psychological, very emotional, right? Chipotle money strategy. So I'll incentivize myself with like insignificant amounts of money. It's all relative, right? So say like $5, right? If this trade hits, I'll try to, maybe I'll bring the lady home some flowers. I'll get myself a bowl from Chipotle. Just stupid little stuff like that, right? But yeah, I don't want to put my life savings money on the line during those dead periods of the market. If I'm really feeling the itch to trade, just give myself a little incentive. Hey, I missed this leg down. All of Twitter, every furu and their mother was in this trade, in this leg down. Apparently, they're all bragging and posting gains. They're all posting Weevil cards on Twitter, and I have FOMO, right? So what I do is I'll whip out the Chipotle money strategy, just little incentive. Hey, if I hit this trade, I'll grab myself a burrito tonight, treat myself, whatever. Little stupid shit like that. But, this keeps me from making those really hard decisions, the account blowers. Okay. All right. Rule number 7, breakouts. Listen, some of you are like, oh, maybe you're good at trading them. I don't know. I have tried. It's just not my thing, maybe, but I cannot trade these things. Breakouts are tough. I am a confluence trader. I like multiple pieces of conviction in one spot for an entry. It has worked really well for me. I think it just makes a lot more sense. And this, listen, 2021, or no, not 2021, but 2020, different time. 2022, the breakout market right now, really tough. Just careful. If you guys like it, go for it. I go light size. I really careful trading breakouts. Excuse me.
Oh, I moved that to the side. Just ignore this chart for a sec. All right, so those are the rules for tonight. Now, the last part, the last section here is I promised we would run the numbers. Okay, so we talked about a lot of different things here. Now let's run the numbers. Let's try and I'm trying to put together my risk management plan in a sort of like a mathematical equation here. Okay, last thing. So running the numbers, what percent of trades do I roughly hit? And I try and calculate these, right? I would do it if I was you, try and calculate this. You know, what percentage of trades did you hit last week? Go back and look. What percent of trades did you hit for the month? So try and get an average there, right? Ask yourself, what dollar risk per trade, or what percent risk per trade? Ask yourself, what stop loss, right? Ask what your daily goal is. We went over this. Ask what is the average percent I need to hit my daily goal per play. Okay, so now I'm going to give you an example. So here are the questions on the left, and here is the scenario. All right, so let me pull up on the right side. Okay, so what percent of trades do I hit roughly? Say you're hitting 50%. Okay, say your risk per trade is 1,000 per trade. Okay, what's your dollar amount that you want to risk? It's going to be 200 for me. Say in this example, say I'm hitting 50% of my trades, which I'm hitting more, but just for easy numbers for you guys to follow along as I sort of talk here. 1,000 per trade, 20% max. Daily goal, I'm trying to make 400 a day. Say I'm trying to make 400 a day. Well, now that I have these numbers, I ask myself, you know, hey, how can I go out there and make 400 a day? What do I need to do? Okay, so let's do the math, right? And I encourage you guys, try and just run some equations on the stuff I talked about tonight. So say I take 4 trades, right? And I calculated from last week, I was hitting 50%. Example, let's hit more than that. Say I was hitting 50%, $1,000 going down per trade. I'm risking the same thing every time for this example. Okay, and based on me taking 4 trades with 1,000 down, and I have a 20% stop loss. Say I'm hitting 50% again. If I took 4, that means I lost 2. That means I'm probably going to lose 2. If I'm taking 4, I'm going to lose 2. So how can I make a risk management system that enables me to profit a daily goal of 400? What do I need to do, right? That means that 2 of my winners need to hit 80% combined for me to hit my daily goal. So I'm okay with taking these 2 losses for 20% on 1,000. But that means that I need to look for 40% gain on the next 2 trades, right? So go out and run the numbers. Hold on. Oops. Go out and run the numbers here. Okay, I take 4 trades with $1,000. I'm losing 50%. So I'm, you know, what stop loss is going to come into place, right? And you could play around with this stuff. Like, hey, if I think 40% on a trade is too much for me to get, then maybe my stop loss is going to have to come down. So this number would go, right, from, say I put this to 10%. These are all changeable. You could change these, especially this, especially this, and especially this, right? So say I put this from 20% to 10%, that's going to adjust how much I'm down right here. So if I'm trying to make 400 a day and I'm going to lose 2 trades because my hit rate is 50% just about, and my stop loss is 20%, that means I'm going to be down 400 on the first 2, and the next 2 that I'm going to win based on the statistics I calculated, those just need to go 40%. Well, is 40% doable for you? Well, if it's not, then maybe the stop loss percent needs to come down. Maybe the downside needs to come down a little bit,
right? So that you could be able to hit this 400. All right. Does this make sense? Like, try and run the numbers. This number is adjustable. This number is adjustable. This number is adjustable, right? Say I move this to 10%. That would mean this number, I take one trade, I lose 10%, I'm down 100. Next trade, I lose another 100, right? Because I'm losing 50% of my trades, but I take two more that are supposed to be winners because I'm hitting at 50%. And, now I'm only down 200. I only need to make 600 to get to my daily goal, right? So I encourage you, and the numbers are going to look different, but go in there and try and calculate this stuff, right? And see with what stop loss is it most realistic for me to hit a certain daily goal dollar amount that I want. And, take into account your pain point, right? Take into account your daily goal, okay? The 50% of daily goal rule. Okay, this is all good stuff I think we talked about tonight. So with that being said, guys, do we have any questions on any of the material for the session tonight? All right, and just stick around because I do have a worksheet and I do have a link that I'm going to send in the chat tonight. So I have a worksheet that you guys could do quick tonight or tomorrow, and then I have I would encourage you to get a trading journal down and literally start writing stuff down: pain point, stop loss, dollar amount you want to risk. Don't let it be one trade that you can lose to hit your pain point. Make it 3, make it 4. How can you make your portfolio impenetrable? Some of the stuff I talked about tonight in my mind, am I going to lose 5 trades in a row if I'm risking 400? I'm not going to hit my pain point if I'm losing. I'm not going to hit my pain point if I'm risking 400 per trade, truly 400 per trade, because I'm not going to lose 5 trades in a row without winning something, right? So there are ways you could really run the mathematics and you can make this really, really a lot easier on yourself, I think. Not saying it's going to be perfect, not saying it's going to automatically make you profitable, right? But just little tweaks to your strat, running the numbers, makes a world of difference. This is when somebody asked about my bond story when I went from 1,700 to 20K and I couldn't get over the 25K PDT benchmark. The difference maker for me was really this. I sat down and started running stuff. Hey, if I just go for base hits, if I write down my risk, if I really just make it advantageous for me to trade rather than put myself at a deficit or a disadvantage, then this is going to make a lot more sense. It's going to be easier. Okay. Don't put yourself in a hole. Don't be your own worst enemy as a trader. That's the worst thing you could do. All right. With that, guys, we have received a lot of positive feedback from the EDU sessions. I appreciate all who have DM'd me. I will say, if you're not interested at all, totally fine, guys. Obviously, I don't care. I've literally posted my P&L and stuff. I don't care. I like helping people. I like, these classes and stuff. If you do not want to see any more content like this, it's all good with me, right? But I will say, I hope that you guys leave here seriously a better trader. Whether you're a part of the Discord or not, you could reach out to me on Twitter anytime and ask questions. I try to get back to you as much as possible. I will say, just DM the shit out of me. I don't care. I might miss it the first time. Just DM me a bunch of times. I'll get to it. What happens is, if you DM me once, I don't look at it, it goes to the bottom. Okay. Cyber Monday, we do have a sale going on. They're all talking about it. I have a separate code I got. If you guys are interested, you liked what you saw, there is a code Dipka for 30%. If not, again, doesn't matter to me. I wish you all the best. Reach out to me with questions anytime. And seriously, I hope you learned something here tonight. Even if you're going to leave the Discord after tonight, I know I posted this on Twitter. We got some new people in here. And just please throw it in the chat. What did you think of this session tonight? Was it helpful? What do you want to see more of? You want more examples, less numbers, more charts? Just for next class, it's really helpful. So appreciate that. And I do have this rule set as well. I will throw this into the chat.
Okay, I'll throw this into the chat. And I also have, there's a website where you see that math equation I just kind of did. I mean, nothing crazy, right? But there's a website that allows you to plug in like stop loss, max risk, and it like kind of calculates what percent you need to hit per trade. It's really cool. So actually one of the old Discord members or alumni showed it to me. So pretty cool stuff there. But yeah, that's going to conclude it. I'll throw those in the member chat and I'll tag everyone so you guys don't miss it. Please, 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 feedback in the member chat, because I got a whole week of my strategy, right, coming up for week 6. So I'm going to be, over the next 4 weeks, I'm going to be building a presentation that's going to be really, a lot of examples, a lot of good stuff. So I appreciate any feedback. And anyone that's going to be continuing with the summit, I ask that, obviously do you if you don't want to do it. But I think that, we talked about starting that trading playbook, write down your why factors. If you haven't seen the first recording, go check it out. It's posted. And for tonight's class, start developing your own risk management system. I think that's smart. Okay. But thank you guys. We're going to end the recording. And if you missed anything or want to go back, I will post this recording for everyone. Okay.